I'd like to call upon Haibing for presenting his paper, which deals with the study on entertainment expenses and how they benefit for the stakeholders. Over to you, Haibing.
Okay, thanks very much, Turner. So first of all, I would like to take this opportunity to thank the organizers of the conference for inviting me to attend this great conference. This is a joint work with Hui from Changkang Graduate School of Business and Sonia from Lingnan University. So as you can tell from the title of this paper, so the key variable of our interest in this study is business entertainment expenditure. So like the dinner we had last night, so we have dinner together and talk to each other so we can get familiar with each other. So this is the expenditure for the for firms at a corporate level. So what is the business entertainment expenditure? Business entertainment expenditure refers to all kinds of expenses to entertain external stakeholders in different forms. So in the rest of my presentation, I will use BE for briefly to stand for business entertainment expenditure. So BE includes different forms such as business lunches, concert shows, and sports events. So particularly, BE doesn't include any expenses used only for insiders like employees and shareholders. So why should we care about business entertainment? So our first motivation is that business entertainment is a long-standing and prevalent corporate activity. So for instance, in the US, BE is officially tax deductible since the inception of the nation's revenue law in 1906. Currently, the tax deductible rate ranges from 50 to 100% in major countries like US, Canada, Germany. I've been searching for this number for India for a couple of months, and also consulted some colleagues of mine from India, but I still haven't found this number. If any one of you knows this number, please do let me know, because it's very important given the size, the economic size of India. The second motivation is that the economic magnitude of BE is sizable. For example, in Korea, it is reported that BE accounts for about 0.2% of combined sales in 2012. In China, BE accounts for about 0.23% of combined sales. If we use net income to scale BE, this number is much huger. It's about the value-weighted number is 4.5%, and the equal-weighted average is as high as 12.3%. I guess it's much bigger than we can imagine. So in Japan, this number is also very big. According to Reuters report, it's estimated that BE probably amounts to 20% of the total cost for small firms. Those examples are from Asia countries. So what about Western countries? Take UK as an example. The corporate hospitality market is close to 1% of its GDP in 2012. Therefore, business entertainment is a long-standing prevalent and economically significant, not only for Asian countries, but also in Western countries. But we still know very little about why firms entertain their stakeholders, and how does this kind of activity affect firm performance and through which channels, whether investors can fully understand this information embedded in BE. So we take advantage of unique disclosure practices in China and investigate those questions. To our best effort, we only found one paper which is slightly related to our paper, published in 2011 in Journal of Law and Economics. There are two major differences between our study and their study. The first difference is that they use survey data conducted by World Bank, while we use real data manually collected from the annual reports for listed firms in China. The second major difference is that the variable of our interest are slightly different. Their key variable is the sum of entertainment cost and travel cost, while entertainment cost is our key variable in this study. So because, as I mentioned in the first slides of my presentation, entertainment costs refer to all kinds of costs incurred for entertaining outside stakeholders, not insiders, while travel cost is incurred by insiders, like employees to do business for a firm away from home. So they need to they need transportation cost and the hotel cost. So those will be considered as travel cost. Therefore, adding those two items up together may not be meaningful, like 1 apple plus 1 pill. So how many apples we can get? We also have opposite findings. They found the ETC has negative effect on firm performance, while we found the entertainment cost has a positive effect on firm performance. The reason why they found a negative effect on firm performance is probably because within same industry, the higher travel cost could mean the more difficult to do a business. Therefore, those firms with higher travel costs tend to have low performance. To understand why firms want to entertain their stakeholders, it is useful to think about how entertainment would affect firm performance. We use three theories to guide our empirical designs. So the first is agency theory. Agency theory implies that BE can reduce firm performance given the business entertainment expenditure could be easily abused by managers. While transaction costs and the public choice theory suggest that BE can improve firm performance by helping firms mitigating transaction costs involved in market-based transactions and achieve favorable outcomes from non-market-based transactions. So because I guess everybody in this room are very familiar with the agency theory, so I just skip agency cost theory and focus on speak a little bit about transaction cost theory. The transaction cost refers to the cost involved in market exchange, so including the cost of discovering market prices, writing and enforcing contracts. The root of the existence of transaction costs is a lack of information. So, entertaining business partners can facilitate communication and information sharing between firms and their business partners. Therefore, this kind of activity can reduce transaction costs by mitigating information problems and secure some profitable business opportunities that might be otherwise impeded by the high transaction cost. So we can have two predictions from transaction cost theory. The first one is that firms facing high transaction costs tend to have higher BE. And the second prediction is that entertaining activities can improve outcomes in market-based transactions, and the improvement is stronger for firms facing high transaction costs. So for the non-market-based transactions, we use public choice theory to guide our empirical design. This theory emphasizes that decisions and outcomes in public sectors are not completely determined by objective rulers and procedures, but could also shaped by the lobbying or other activities such as entertainment of interest groups or powerful economic actors. The effectiveness of lobbying or other activities depends on the degree of influence, which further depends on these three factors. The first is the ability of lobbying group to get access to bureaucrats. If you want to persuade somebody, you need to contact him or to meet him. So the ability, the accessibility is important. And also the information sharing. If you want to persuade somebody, somebody have to listen to your advice. Otherwise, there is no way you can influence him. The third one is whether the perceived power and the favorability of the lobbying group versus their competitors in the eyes of bureaucrats are different. So we have two uncertain predictions from this year and one certain prediction. The first prediction is that the politically favored firms could spend more or less on BE. Because I will explain these predictions later. And the second prediction is that entertainment activities can generate benefit for firms from non-market-based transactions. The effect could be either stronger or weaker. I will explain these predictions later. So this is the roadmap of our empirical design. So first, we will explore why do firms entertain their stakeholders. Then we investigate whether firms can benefit from such kind of activities and can market participants fully understand the information embedded in BE in terms of stock price and earnings forecast. And fourthly, we investigate through which channel BE can affect firm performance. At last, we test what factors will prevent firms from optimizing their business and time expenditure. So this is the dataset description. There are two features I would like to emphasize. The first is that the disclosure rate. So not all firms disclose this kind of information. Only a part of firms. So for example, 2014, there are about 77% of firms disclose this information because this is not mandatory disclosed. So our data have a self-selection problem. So we use Heckman's two-stage model to correct for this self-selection bias. And the second, there is an anti-corruption campaign initiated by the Xi administration at the end of 2012. I guess many people in this room know this anti-corruption campaign. And we can see that for the last 2 years in our sample, the BE, the magnitude of BE dropped a lot. So this is the summary statistics of BE by industry. So the one thing I want to point out here is that you can compare the industries at the top of this table and the bottom of this table. As we can see, the difference is that for the industries at the top of this table, and the products or services provided by these industries, their quality is hard to be evaluated. Like a software or a movie, it's very hard to evaluate its quality. But at the bottom of this table, like utilities, real estate, those are very standard products, and its quality is easily be evaluated. So for firms, for industry with products with a high, its quality is hard to be very evaluated. They tend to have high BE, which is consistent with the transaction cost theory. Because for those industries, they face high transaction cost in doing business. So based on three theories, agency transaction cost theory and public choice theory and agency theory, so we construct a bunch of variables to explain why firms entertain their stakeholders. This is our model specification. We use the Heckman two-stage model to correct for the self-selection bias. And for the determinants of BE, so we use total asset to scale it. Because entertainment with non-market-based stakeholders like government and creditors will not directly generate sales. If we use sales to scale it, it's not appropriate. So this is the first result to the determinants of BE. As we can see, the difference between the column 2 and column 3 is that the column 3, we further include the firm fixed effect. Take column 2 to interpret our result. So all variables we constructed to capture transaction cost effects of firm have predicted signs, although some of them have insignificant coefficients. When we use control firm fixed effect, like political connectedness and litigation risks become significant, which suggests that firms, politically favored firms tend to spend more, and firms firms facing high transaction costs tend to spend more on business and time expenditure. While the evidence for the corporate governance is mixed. Like the first one, the fraction of outsiders, the coefficient is negative, which suggests that some business and time expenditure could be abused by managers, while managerial ownership, remuneration, and the incentive scheme have positive signs, which is consistent with the value-enhancing perspective. So the evidence for the corporate governance is mixed. So next, we focus on our main result, the effect of BE on future firm performance. Because business and time expenditure has an endogenous problem, so we use instrumental variable to mitigate the endogenous issue. And in a few pages later, we also use the difference methodology to mitigate endogenous problem here. So instrumental variables here is we follow previous literature and use the media of BE, media BE of other firms within the same industry in a given year as the IV. So the underlying logic is that firms within the same industry share some common but unmeasurable factors that could affect BE. such as specific product attributes and industry regulations, just we showed in the slides before. And the industries, the different industries tend to have different business and time expenditure. So this IV meets 2 criteria for good IV: the relevancy criteria and the validity criteria. And at the bottom of the slide, we have some statistical tests for how strong this IV is. This is a very strong IV, as those numbers suggest. This is our mode specification. One thing I would like to mention that is, for the outcome, we use total asset at year T as a flatter. So because the advantage of this specification is that we can interpret the coefficient of BE as a $1 increase in BE would need to beta dollar increase in the outcome of interest. And because to make the table is more readable, we multiply the BE by 100. So BE here is a percent. So in panel A, the dependent variable is asset turnover, which capture firm's operating efficiency. Panel B is the ROA at next year, and the panel C, the dependent variable is the firm value at next year. So column 1 is column 1 include industry year fixed effect, and column 2 further include 1 year lag the dependent variable, and column 3 include firm fixed effect. And at the last column, this is the IV estimates. As we can see here, the result, all those estimates suggest that BE improve firm performance. And the economic significance is very huge. $1 increase in BE would improve sales by $17 in sales, and $2 in net profit, and $37 in Tobin's Q. So here we use a causal-natural experiment to further mitigate endogenous concern. So because of this anti-corruption campaign, the SOEs suffer more reduction in BEE. And SOE, therefore, here is a treatment group, and the non-SOE is a control group. We use a propensity score to find a non-SOE for each SOE. Here is the result. Panel A reported the univariate test. As we can see here, the BE for SOEs indeed experienced more reduction in BE. And also, they experienced more reduction in firm performance and firm value. And the panel B report different difference regression, and the numbers in the red from box suggest that the SOEs experience more reduction in firm performance in the post anti-corruption period. Here is we test the reduction in BE directly on firm performance, and this result again confirm that the reduction in BE would need to decrease in firm performance. So next, we focus on the predictability of BE and firm performance. The panel A and B use portfolio methodology, and the panel C use Macbeth regression. All those results suggest that BE can predict future stock returns. Therefore, market participants fail to recognize the information embedded in BE about future stock returns. So because Chinese stock market is dominated by retail investors, next we look at the professional practitioners, analysts. So whether analysts undervalue the information of BE embedded in BE about future performance. Here we see that the BE can predict future unexpected earnings, suggests that analysts also underestimate the value of BE. So next we investigate how do firms benefit from market-based transactions by looking at customers, suppliers, creditors, and governments. So the first 2 columns, the dependent variable is litigation incidence at next year. So if firms have high BE, they tend to have low litigation lawsuits with their business partners at next year. And the columns 3 and 4 suggest that BE firms with high BE tend to have high quality of trade credit extended to customers. And the last 2 columns suggest that the BE can help firms to secure more trade credit from their suppliers. So next, we look at the government subsidy and the collateral requirement when firms borrow money from banks. So panel A suggests that the BE can help firms to secure government subsidy. The magnitude is also very big here. And here is the BE can help firms to lower their collateral requirement when they borrow money from banks. So at last, we investigate which factors, because we found that BE can improve firm performance. So a natural question is that why firms don't spend more on BE to improve firm value? We propose two explanations. The first one is accessibility to key decision makers of stakeholders. If you want to entice somebody, you have to successfully invite somebody to have an attempt with you. So the accessibility is one barrier. And the second is the existence of a managerial agent problem. If managers don't get any benefit from an attainment besides enjoy the attainment itself, so the managers may prefer to go home to stay with his family, right? So this is the second reason why firms don't spend more on BE to improve their firm value. So here is the result. This is accessibility to key decision maker of stakeholders. And those results are consistent with our conjecture. And this is the result for the existence of managerial agency problem. And also this result is consistent with our prediction. So conclusion, so we found that BE can reduce transaction costs in market-based transactions for firms and secure favors in non-market-based transactions. And the evidence on the role of corporate governance is mixed. And yes, the BE can improve firm performance in terms of operating efficiency, profitability, and firm value. And but market participants and analysts don't fully understand the information embedded in BE about the firm future performance. So BE benefit firms can benefit firms through different stakeholders, like low litigation incidence and improve the quality of account receivables and help firms to secure more trade credit from their suppliers, and also help firms to get more subsidies and lower their collateral requirement when they borrow money from banks. So there are two factors at least prevent firms from optimizing their business and time expenditure. One is accessibility, the other is managerial agency problem. So this is the first study systematically explores the reason and the benefit of attending business stakeholders. We also contribute to the young but growing literature on the importance of social networks in corporate finance. Previous studies found that the social networks can facilitate various corporate activities, while our study focuses on the activities that build up the social networks. And also this data can be used to study issues related to transaction costs at firm level. Thanks very much.
Thanks, Ivy, for your presentation. I'd like to request Subhrata to present his views.
So good morning, and thank you for asking me to discuss this paper. So let me just give a brief overview. There is not much time for discussion, and the presentation is always the presenter presents his or her paper the best. So just to summarize, this paper examines if BEE, that's business entertainment expenditure, influences firm outcomes, and in this paper we measure it by these three outcomes: sales, profit, and valuation. Then it analyzes if these effects are fully anticipated in the market, and the result, of course, is that it is not, and there is markets react a little bit with lag. Very interestingly, it identifies also the channels through which it works, because that's very important to understand. Of course, we regress Y on X, then we say X influences Y, but it's very important to understand how it influences. Just like the literature on financial dependence and growth, we know it affects, but how it affects is much more important than the effect itself. So it identifies various channels, lower litigation incidence, better quality trade credit to and from customers, higher government subsidies, and lower collateral requirements. And then, of course, it justifies because the effects are huge. $1 on BE increases market valuation by $36. I put all my resources in doing BE apart from doing any other work, because that the effect is very huge. So I must provide an explanation as to why I cannot take it all the way, because otherwise somehow it's not closed. So here, contribution, as I also Googled and found out that very few papers are on BE, so obviously it's a new thing to analyze. Meticulously hand-collected data, I mean, as you know, in R&D expenditure or other things that we collect in India, if you go to any database, you don't get much, but so you collect this data hand-collected. They put a army of graduate students who compile this, and so that's very nice. Innovative use of Heckman's model to correct for self-reporting bias. Because I think about they started with 20,000 odd farm year observations, and their final sample is something around 13,000 or 11,000 in certain cases. So people do not automatically report BE. In India, for example, they do not report R&D expenditures or something like that. So there's a huge sort of drop in the sample, and you have to correct that. Only the good farms are not reporting, the farms with lower governance problems are reporting BE. So selection bias is an important, and they handle it very intelligently with the Heckman's model. Robust results, I mean, lots of outcomes, lots of different ways of defining BE, so results are always robust. Particularly useful is the attempt to identify the channels, which I said, and usual techniques for handling endogeneity, which is now almost a cliche in empirical work. I mean, everybody has one slide and everybody uses IV, so I mean, paper does the same thing. So I will just offer some observations, some comments. This is the way that while reading it, I thought some questions came up in my mind. These are sometimes clarificatory questions. Some are a little bit more involving technical questions. One, the nature of BE. Is BE the rent-seeking expenditure to manage favorable outcomes, or is it usual business development expenditure? Because somewhere there is a normative issue going on with this business entertainment, because when you say, does it help to entertain your shareholders, there is some governance, because I work in that area. There's some governance angle, and this is important because in several places in the paper you use the word corruption, political correctness, and things like that. So is BE capturing a sort of a governance variable, or it is an usual meeting expenditure and stuff like that? Because it's some in the presentation, and while reading the paper also, I saw that you said this is external shareholders, it has nothing to do with employees, external stakeholders, it has nothing to do with expense on shareholders and employees. I'm just wondering that suppose I go, or me and my colleague from a company go and then meet other two people who are my suppliers, and then we go to the concert and we buy 4 tickets, for example. Then is it true that this out of the 4 tickets, the other 2 tickets which are on me, which are the employees, are booked separately compared to the other 2 people on whom it is not booked? Because as I saw the details that you give in the sales expenses or management expenses, it's called business entertainment expenditure. So it obviously includes expenditure on people who are in the concert, and that would include employees both from inside as well from outside. So suppose I just look at this, that this is a sort of a meeting expenditure, because we go there, we meet, we need not always meet so formally here. We'll discuss, then we'll have a drink, and we'll go there. We are still discussing business. So there is no separate entry in that balance sheet or in the profit and loss accounts which says meeting expenses. So presumably all meeting expenses and entertainment expenses are all clubbed together. So if we want to, for example, want to emphasize this corporate governance angle of that means are you doing this as a rent-seeking activity, as a corruption or not, then probably it will help. This is just a suggestion that will it help to look more closely at firms which incur more than usual BE, maybe the top percentile, top quartile firms, and show whether there is more than usual performance in some sense. That would establish some sort of a corporate governance angle, that people who do something disproportionately more, they get disproportionately higher returns. So sort of a regression discontinuity approach might even strengthen the result, because there is, at this moment, I am not very clear whether it's a usual business development expenditure, then the effect is obvious. But if the corruption or the governance angle is to be emphasized, then something little bit more would be helpful. Effect of BE on unanticipated by markets, I think it's a very intuitive result, because building relationships, exchanging soft information like trust and familiarity, etc., are not immediately observable by the market. So it is obvious that market will anticipate it a little bit later. little bit perplexed by one observation, that unanticipated market effects last for 12 months. That means it shows up even after 12 months. That's what I read from the paper. There is one full year which is the same when the effect of BE shows up in the accounting performance. Normally, I will expect the market will absorb it much faster, so then that effect should not last as far as the accounting year. So that's one way to see it, or maybe one can look at sort of a declining graph of a market response and see that most of the effects are in the beginning and some of the effects are much lower in the later months, because now the accounting effect and the market effect are of the similar periodicity. Channels. Channels is a very good idea, I think, and of course here ideally what we look that BE needs to be tied to expenditure made on customer, supplier, governments, creditor, etc., because these are the outcomes. And if I could relate the BE made on this type of people, then it would have been a more direct causation. Unfortunately, this is not possible because we just get a data on total BE. So we regress specific outcomes on aggregate BE. So unfortunately, the data doesn't permit this. So is there a way to make these results a little bit sharper? Say trade credit effect, for example. Is the effect of BE higher in industries or for firms which have higher dependence on trade credit? So, and then subsidy effect. Is the effect of BE higher for industries, firms that rely more on subsidized inputs? So that is an imperfect way of connecting BE to a directed sort of towards the supplier or a consumer. So some suggestions is whether an interaction model helps or not. That means we interact BE by the nature of the firms and something like that. Econometrics or empirics, just some observations that why does BE affect outcome with a lag of 1 year, not in the same year, because an accounting year is a long period. It's like a 1 month, 1 year. So you might just regress YT on XT. Sometimes we do a regress YT on XT minus 1 to take away a little bit of sheen of the endogeneity issue. Of course, we just a simple observation that even regressing with lags doesn't take away the endogeneity completely if there are autocorrelation in the process and stuff like that. Are there better instruments? Everybody has something to say about the instruments. Of course, when anybody chooses an instrument, they do a test. Every econometrician will do that test. So, but then instruments are loosely defined as not correlated with the error, but correlated with that X. So, I mean, that's like saying it should be not correlated with the error, but how much it is correlated with the X, that's anywhere from 0.1 to 1. So, one point that I just thought of, and when you explain it in your words, not econometrically, because econometrically you do find that it's a good instrument. You say that we take the median of other firms because that is likely to be correlated with my BE because of common industry characteristics, but unlikely to be correlated with my performance. That's what you say. I'm just simply pointing out, I mean, people coming from the IO sort of a literature that they will think other firms BE affect their performance by construction, and their performance might also affect my performance because of game theoretic setups and stuff like that. So maybe that word line has to be read a little bit, written a little bit guardedly. Now, exogenous changes in announcement, it affected all firms. That means that was a general announcement that everybody should not do too much of BE. So that would reduce BE for all firms. So perhaps it will. What is important is relative BE because everybody is making BE expenditure. So while maybe we look at firms with large changes because that announcement is a general announcement which is applicable to all firms. So everybody would reduce. Who reduces more, that should show the effect, not just only the exogenous change. Second, third one, why look at decline in performance of SOEs and not firms that are more connected to SOEs? Because one confusion I had, are SOEs receivers or givers of BE? In the sense that we spend BE. Suppose I spend BE on you, so I receive the favor from you. It is more likely that SOEs have critical decisions to make and stuff like that. So what is more important is not the BE of the SOE, the BE, or it should be more important to have the BE of the private firms who interact with the SOE and therefore by making BE can influence the SOE. So I'm not very sure why only the logic of giving that the performance of the SOEs is will fall is not established unless we show that SOEs in general use higher BEs than private sector. And even if we show that empirically, we must find it out a way that what does the private player have which makes the SOE management spend so much of BE. So we must establish the connection of input and output. Finally, just maybe a typographical thing in the paper, check sample observations, because somewhere you write 20,000 and then we say they report B for only 13,000. After that, the sample size becomes 17,000. So maybe some typographical thing. Reporting years, in some tables it is written, I think in table 1, the reporting years are 2004 to 2012. Next table, the next third table is 2014. So these are minor things. And reporting rates, which I could not understand, because you said that we have so many observations, and of which we only take those observations which with valid BEs, 13,000 or something like that. And then you work out a reporting rate. So I understand there must be another bigger sample for which the farms are there, but they have not reported BE. Then only you will get a reporting rate. Because if you take only the farms with all observations which have only B, then the reporting rate within the sample is always 100%. So I could not understand that part. There must be a big sample of all farms. These are the observations which I get of farms which have reported B. Then I take that 400 and say the mother sample is 1,000 NSE listed farms. So the reporting rate is 40%. It's just my understanding, I think, on the total number of farms on which you are using to calculate the reporting rate could be made a little bit clearer. Then it will help the reader. So enjoy reading the paper, and I think it's a very meticulous work, 62 pages paper, hard time for me to read. I did it, but I think it should be published in a top-tier journal. And thank you for coming to India and presenting this.
Thank you, Shuratada. I'd like to now open the for more question and answers. Haibing, we'll take some question and answers, and you can report. You can answer them all together, please. Yeah. Yes, Dr. Vaidya.
Can there be some firms who really have zero expenditures on BEE? Or is it an impossibility? Are we looking at a situation where you are going by the impression that everybody undertakes expenditures on BEE, some report, some don't? But if there are some firms who in principle say that we are not going to spend anything on BEE, and they really don't spend anything on BEE, then how does it affect what you have done? For example, in India, you have some firms that genuinely have zero trade credit on both sides. Okay, so that is not a question of whether the firm. So it's not a question of reporting. It is the policy of the firm neither to give or receive trade credit, and there are a large number of these firms. Okay, now, but if it is an expenditure, then you could have corporate policies that say that we do not indulge in this. And if such firms are actually observed, then how does one econometrically take care of this and then reinterpret the results that you have? Yeah.
Yes, Mr. Anand.
See, you had that one tabular column, where that announcement was made in China to reduce BE, and before and after. You had after minus before, and you found actually the data shows that performance has come down. Right? One figure there is positive, and that is Tobin skew. Can you just comment on that? What is the reason for that?
The next question from Professor Yadav.
You mentioned that business entertainment expenditure is following up really on Subrata's point. You have a single number there. And when you think of China or you think of India, the obvious thing which comes to mind is how much of that business entertainment expenditure is really something like bribery or corruption in disguise. And arguably, a rational bribery would be rational for a firm only if it generates value which is more than the amount of the bribe. So it would be a positive NPV transaction, and therefore you'd expect to see it reflected in value. And yet would not be easy to anticipate from the perspective of the firm. So if this was a study based on, say, US data where bribery is kind of illegal and most public firms would not really engage in that. But given that we are dealing with a Chinese firm or Indian firm, the obvious question is how do we separate out bribery from business entertainment expenditure? Bribery is an interesting subject. I'm not saying it's not. But can we separate it out in some way? As Subrata suggested, can we have some very large payments or something, some other way to differentiate between those two to be able to distinguish between the two?
We'll take the last question from Krishnan, and then you can give your replies to it.
This is a very minor point, but at the start of your paper, you were trying to reconcile your paper's results with the one comparison paper that you had. And you noted that those guys had measured their variable as business entertainment plus travel. Now, if you also have travel, the travel numbers in your sample, then you could make a sort of a better reconciliation. Suppose you added up business, entertainment expense and travel, then would you recover their results? So which would.
So I will answer the discussion's question first. And if I miss some questions, comments, please let me know. So the first question is that whether we can decompose BE into rent-seeking expenditure and Euro business development expenditure. So unfortunately, because this number is an aggregate number disclosed in annual reports, so we are not able to do that. Because it's just normally the firms, as you can see in the paper in Appendix A. So normally firms will disclose this kind of information in 3 sections. One is under the sales expenditure and the management expenditure and the cash flow, which is outflow, cash outflow. So the numbers in cash outflow is the sum of the BE and the business and the sales expenditure and the management expenditure. So this is maybe we can go to separate the BE into one related to management expenditure and one is related to sales expenditure. But only a small part of firms do that, and some other firms, a large part of firms only disclose this number in the cash outflow section. So we are not able to do that. And for the why, when we check the stock returns, why we use 12 months? Because this number is annually disclosed. And before the annual reports disclosed, at this year disclosed, normally in China, at the end of the April in the next year. So before that, we don't know how much BE a firm spend in this year. So this is why we use 12 months. I think there is a declining effect because the investors can use previous BE to predict how much it would spend in the next year. The theory correlation is pretty high. It's close to 0.7, if I remember it correctly. And because the BE disclosed in the annual reports is at the aggregate level, so when yes, it is a problem to look at the aggregated BE on specific outcomes like trade credit. we did do that. We use some subsamples, like as you suggested, whether the BE has a high effect for some industries. So we don't look at the specific industry, but we split sample into firms with a high transaction facing high transaction cost versus firms facing low transaction cost. I think this is the same to your suggestions. I have to admit that our IV is not a good IV. We try several IVs like number of dialects and the transportation, because when we can meet each other easily, so maybe we don't have to go to have expensive entertainment. Unfortunately, those IVs are not good. Cannot pass the criteria test for the good IV. We follow previous literature, use the media BE of other firms within some industry, because like advertisement, the BE, the media BE of other firms within some industry would not affect would affect me from performance directly, but it would affect me my expenditure on business entertainment. Like advertisement, if everybody do advertisement, if I don't do it, so the customers will see others' advertisement. So to control for the industry heterogeneity, we also control, in our estimation, control industry year fixed effect. So the next question is why we look at the decline of performance, in performance of SOE. Because this anti-corruption campaign targeted all types of firms, but there is another regulation which released on December 4th, particularly on government officials and the leaders of SOEs. So SOEs, if you see the government website, there is a particular section for some like violations on the government officials and the leaders of SOEs violate this regulation. So this is why we use SOEs as a treatment group and non-SOEs as a control group. As the data show that the SOEs relatively experienced more reduction in BE. We are not sure whether, BE here is just at the aggregate level. It's firm expenditure on entertaining other external stakeholders. And so it's hard to say that SOEs are receivers or givers of SOE. Because we don't know firms, their customers and suppliers, so we don't know which firms are more collected to SOEs. So for your question on the, let's see, for your question. So indeed, there's some firms only have zero expenditure on BE. When they have zero expenditure on BE, they would disclose zero on their annual reports. So we use this as a non-missing value in our estimation. So on the top insecure problem, because why SOEs and non-SOEs actually experienced an increase in top insecure, because in 2013 and 2014 there is a bull stock market in China, and actually the increase in top insecure is lower for SOEs. And so whether we can decompose the BE into Euro BE and the bribery BE, it's pretty hard. We try to figure out how to do that, but unfortunately, if you have any suggestions, please do let me know. Thanks. Back to the last question. So the only study related to our paper is the one use the survey data conducted by World Bank. Actually, I checked the survey. So the BE and the travel cost, They're separately reported. I don't understand why they add them up together. So because for our data, we don't have travel cost. Indeed, some firms disclose this data, but we have to hand collect again. So we only focus on untamed cost at this moment. Thanks.
Thank you, Subhrata, for going through the paper and providing your views on this. Haibing, I hope you can take the comments back and
Thanks. Yeah, it's
have
indeed
those
very
have been
useful.
useful for you.
Yeah.
Thank you, everybody, for attending this session.